Good afternoon, everybody. It is December 20th, now known as Joe Manchin Day. So we will see if Joe Manchin Day turns into Joe Manchin Week, and Joe Manchin Month, and Joe Manchin Quarter, and Joe Manchin Year, or if they just name a sandwich after him. Who knows? All right, so what did I publish today? Stocks of the Week. New article. A lot to like in SMID and cap techs and value price dividend stocks. What are SMID caps? That's small and medium-sized companies. I defined it as about 500 million to 12 billion. The old definition was 500 million to 10 billion, but I have bumped that up just a little bit. I think a lot of people actually were even using 5 billion, but I basically define mid caps as anything that's not quite on the S&P 500 yet. So to get on the S&P 500, you got to be about $12 billion company now. And why do I like the smaller companies? Well, if you take a look at the S curve here, you can see that the big hockey stick is right in here. So I'm trying to invest about here, just approaching the inflection point. Sometimes I end up investing way over here. And then people get mad at me and they're like, oh my God, it didn't go up right away. We had to wait a year or 2 years. I'm sorry about that. But I've made all my money on this. I don't make my money on this up here. I make my money from here to here. That's what I did with Exact Sciences. That's what I've done with 20 other companies. And that's what I'm always looking for. Now, that doesn't mean that we don't want some value stocks. We do, but we'll get to those in just a second. So you have Peter Lynch telling you, hey, companies go up for one reason. And really it's two. I don't know why he says one reason here. I should really just cross it out. There should be two real reasons. They either go from doing poorly to doing well, a turnaround, or a small company becomes a large company. And I pick out a lot of both of those. The problem with turnarounds obviously is they don't always turn around. And the problem with small caps is they don't always get bigger. But if you focus on those two types of companies, you are getting huge price inefficiencies. What does that mean? It means that everybody hates it. It means that they've thrown it out, and it's usually selling for way below what the value is or what the future value is. And that's what we're looking for. We're looking for people to be emotional, go, oh, I hate it, I'm going to sell it, it went down. Well, and then it goes up, hundreds of percent, and they're like, oh, well, somebody else did something wrong. Do I mock? Yes, I mock. Why do I mock? Because I like Monty Python. But the real reason is I see so many people not knowing what they're doing. Look, you can buy all mega caps. You can get mad because you didn't own Apple all the way to the top or Microsoft all the way to the top. The reality is yeah, there's that small basket of stocks on QQQ and then just a handful more in the S&P 500 that you're going to want. However, the big money isn't made in the biggest companies. That's where your stable money comes from. That's where your volatility control comes from. But reality is that they've already made their big money. So will they keep drifting up? Sure, inertia and competitive advantages and a big wad of cash. But you're not going to see Apple go up from 57 when I bought it to whatever the split adjusted price is now. So what do we look for? We look for the smaller companies. This is from the hype cycle for emerging technologies from Gartner. I encourage you to read this article that I linked, and it talks about all the big technologies that are coming. I've talked about data. Data is one of their most important ones. Who's going to be big in data? Satellite companies. So there are a lot of companies in our buy zone. Black Sky, Planet Labs, Spire Global. The charts are in here. We've talked about them a lot of times. Jumia Stone, for sure. PayPal and Square are getting close. Palantir, you're going to want that one. I'm not sure if it can go down a little lower. I think it can. But my biotech or healthcare basket is Ginkgo Bioworks, on track and Huron right now. Why? Because they all have massive addressable markets. Massive. They don't have to be 100% successful. They can have a lot of little things go right, and if the big thing doesn't go right, they still do well. If the big thing goes right, or the 2 or 3 or 4 or 5 big things go right, then they kill it. I think Ginkgo Bioworks is probably $200-400 billion company. It's going to be every bit as valuable as, you know, your Pfizers and Mercks of the world. So whatever they're up to at this point, take a look at those. Let's see. Let's take a look at Pfizer real quick, just because that's a stock that I've been pretty high on. Let's see. PFE. How about we do it this way? PFE. So where are they? Market cap of... Having a hard time today. My search bar disappeared. So you can open. There we go. Pfizer. Where are they at? $333 billion. What is Ginkgo Bioworks at? Nothing. They don't even have it listed on Seeking Alpha. It's a few $1 billion. So here's my question. If a company, this platform company like Ginkgo Bioworks, has a chance to get a piece of dozens and dozens and maybe hundreds of projects that other companies, the smaller companies and universities are doing, why can't they be a 9-figure stock? I think they're absolutely going to be a 9-figure stock. It's going to be 100 billion. It's going to be 200 billion, 300 billion. I don't know. But it's a company in the right place at the right time. And if our ability to sneeze on each other gets worse and create even more diseases, we're going to need them even more. Heron Therapeutics, you know, I love them because they have a replacement for Oxy. And On Track, I think they're just way too low. Huge addressable market in mental health care. I think they just cut a deal with Salesforce. We don't know the company for sure, but it appears to be Salesforce. You know, this is a basket where I think just that basket right there is a nice little self-made healthcare ETF. Throw in some Pfizer, and I think you've got a great 4-pack. Zoom, Teladoc, and DocuSign, not quite there yet. They are Kathy Wood stocks. That comes with two things. One, they're very well researched, but also her fund is under attack because you can trade options on it. That means that they could beat it up pretty bad, which means that she might have to sell things that she'd rather not sell, drives those prices down. So back when ARK was, what, 130, and I told somebody not to buy it, he has since quit the service. But when ARK was, about 130, I told him I wouldn't buy ARK above the 80s. And he said, you think ARK is going to get into the 80s? And he fired me. He like within days, he discontinued. I think somebody else asked too. I don't know if they're still around. I don't remember who it was. But, you know, now we have ARK at $94.72 today. So from the 130s to the 90s, probably should have kept paying me, right? No, whatever. I hired Shooter. I got Shooter on board because he's a much better trader than me, but most of what I say comes to pass because I'm stealing from really good people. Now I talk to some smart people, hence Sean Stein-Smith next about cryptocurrency. All right, so your dividend value stocks, AT&T and Comcast, they're crazy cheap. When I say crazy cheap, I mean crazy cheap. Right? You got AT&T at 6-year low, right? It's just so low. A lot of authors are talking about AT&T now. Suddenly there's this deluge of articles on Seeking Alpha about how they love AT&T for this reason or that reason or the other reason. I found one article that had it half right and another article that had it half right. The one guy said AT&T is going to get revalued up to where Verizon is, and he's right. It is. In fact, because Verizon doesn't really have fiber, AT&T should get a better valuation than Verizon come the spinoff with Discovery. But wait, there's more. There's Discovery and Warner merging together, and you get a big hunk of that company, which could be tremendous. I think it's going to be every bit as good as Disney. Will it get the Netflix levels? I don't know, but for sure Disney levels. And then we have Comcast. They also have fiber, and they're selling wireless now too. They could end up spinning off NBC Universal. Who would they merge with? I don't know. Maybe Viacom. Maybe I don't know. I don't know who they'd merge with. Maybe they'd spin off by themselves and then absorb some smaller players. Hard to know. The Justice Department is a little bit more fangy lately. You got Elizabeth Warren, who's tweeting about Elon Musk and AT&T and Joe Manchin. I mean, she just must be going crazy right now. So I don't know. I don't know who's going to do a deal with Comcast, but I think one's coming, and I think that'll unlock a lot of value. You got Viacom CBS down here. They also are in the merger and acquisition business, I think. They have been in the past. I think they will be in the future. I think AMC Networks makes a lot of sense for either them to merge with or for NBC Universal to merge with. I think AMC Networks will be on its own. And in fact, I'm probably going to take a small stake in that. I'm going to add it to the VSL. I might even add it to the plug and play. But I think that AMC Networks is ripe to get taken over. I think it'll happen. I think it'll be Viacom or NBC that takes them over. And I think that that'll unlock a lot of synergies for them. But really, it's a small play, right? I mean, AMC is like a $2 billion company. These other companies are much bigger. So really, you're just trying to see what the purchase price is for AMC. And then you probably, trade out of it. So it's not something I'm going to own for a long time. But I think it's probably a pretty good trade. So maybe somebody will do some shootering at that and give us a nice Elliott wave chart. All right, finally, the last couple that I'm looking at are Ford and Lockheed Martin. They're not there yet. I had the Lockheed Martin chart up and the Ford chart up. Let's pull Ford back up. I have a hard time thinking it'll get much below 17-ish. But if, things hit the fan, get all the way down to 12-ish again. I mean, that would be a gift. I mean, if I could buy Ford down around 12, oh, I would just love that so much. Love that so much. I don't think it's going to get all the way down to the 618. It's just hard to see it getting below this peak and below this support, right? Fought it, got through, came back, then I rallied ever since. So 12-ish, man, if I could get 12-ish on Ford, I'd do a happy dance. Otherwise, yeah, I'm thinking 16-ish. All right, you got Lockheed Martin. Again, not quite there. It doesn't quite want to get there. We've talked about it. And it sniffed our zone that one time. So it gets down in here 300-ish. Then I can get into it. But that 10% down, that's a big deal for future returns. So yeah, I do want to get it down there. Man, if we get a bigger sell-off and get it down here, that'd be fantastic. Don't see it happening. But their space, I've been reading about their space technology. They're a big deal there too. But again, big company, not a ton of upside, right? But if you're a dividend investor and you just want to beat the S&P 500 by a couple of points, Lockheed Martin probably be one of your safest ways to do that, along with Berkshire Hathaway. But Lockheed Martin, pays dividend. Took a look at Cummins. I think that they've got a pretty bright future, so we can get them down here. 180-ish, when we get close, we'll let Shooter do his thing. But 180-ish, that's where I feel pretty good about the fundamental value, and it's got some support in that zone. Now, could it break through? Yeah, I mean, just got to remember, there is no reason we can't go back to the 2020 or 2018 lows. There's no reason. That happens to coincide with where things kind of plateaued in 2015-16. So this area here, above this red line, just above this red line, it can happen. I don't think it's going to happen, but if the momentum gets bad and the millennials flip the switch and start buying puts and they can't get Build Back Better passed and Fed ends up being stubborn about, QE again, we'll see. But just remember, QE is dollar dependent. When the dollar is strong, they have a lot more room to do QE. So we'll see. One thing that I'll point out, and I have talked about this in the past, the reason why we can do QE and we can deficit spend is because as a percentage of GDP and as a percentage of money supply, more importantly, that's not so bad. It just isn't. So against money supply, that's gone down as a percentage. As a percentage of GDP, drifted up, but not much. So as long as we can keep the wheels from falling off, the dollar is going to be fine. That's one of the things I'll talk about with Sean Stein-Smith next, and we can go from there. So I'm going to probably do more updates. I'll throw them out there as quick thoughts instead of stocks of the week, but you'll probably get a few quick thoughts here in the next week. As I talked about on Friday, and that is posted now, find it real easy at the bottom of fundamental trends, right? Pretty easy. I have it playing the investment 2020s videos. You have to go to the page. You have to go to a page to see the future of energy, stocks and options, global trends, ETF, your popular uploads. Stocks and options where we have, shooter stuff. I just want to say, I think it's very important that you watch these videos. I know that not everybody's doing it, and that's a shame because we fly through a lot of things, and I think it helps the people who listen. I could be wrong, but I'm pretty sure it's valuable. So I would encourage you to spend some time. I'm shortening these up. I'm trying to make them concise. And with that, goodbye. I will see you again shortly, not this Friday, but next Monday. And I'm doing the 2 interviews with Amidas CEO Eric McAfee tomorrow, Sean Stein-Smith in a half an hour. And then we will probably see a couple of short videos for me on particular topics. I want to make them topical. How to build an ETF, your personal ETF in healthcare, in emerging markets. I really want to talk about emerging markets. I'm not going to do it today, but one of the things I mentioned in chat over, I don't know which chat it was, is EMQQ is the one we've been looking at because it has both the frontier stocks and the China stocks, right? It has the emerging markets plus China. And if you don't want the China stocks, they have another fund called FMQQ, I believe it's a symbol, frontier stocks. It's basically EMQQ minus China. And then you also have KWEB, which is the China stocks. So instead of doing everything in EMQQ, you could split them up, right? You could buy FMQQ when you think that one's ready to go, and KWEB when you think that one's ready to go. So I'll write an article on how to do that. So if you want to put them together, if you think they're both priced right at the right time, you can buy EMQQ. If you want to keep them separate, right? If you want Mercado Libre and Stone and Jumia and all the other stocks on FMQQ, go ahead and do that. And then when you're ready to add, Alibaba, Tencent, JD over on the China side, you can buy KWEB. So I'll write an article about that. I'm going to write a bunch of articles about how to build your own things, right? So how you can manage these pieces of your portfolio. One thing that I did talk about in here is if you are a growth investor, right? If you're 50-ish or younger, I don't think it's a bad idea to have half of your money in SMID caps. I really don't. I get called out for that. Oh, that's a lot of money. It's a lot of volatility. You know what? The money is made in volatility. Once you accept that, once you embrace the variance, right? That's a poker term. Embrace the variance, and you learn how to live with volatility. You can make so much more money. I was playing poker last night online. I played 3 tournaments at one time while I was fixing a website and reading an article. In fact, I think I still have the article up. I don't know. It's up here somewhere. I have like 100 windows open usually. I was reading an article from Tom Lee about what to expect here. And, I just keep coming back to the large caps aren't the place to be with most of your money. Even if you're retired, I think you need 25 to 35% in small and mid caps. Because A, you're going to live a long time. B, if it's for inheritance, why wouldn't you give your kids and grandkids better stocks that are growing? So once you start thinking in these ways, and just what's my best way to make money long term, you start moving away from the large caps because they're so high up on this S curve that there's more downside for most of them. And that's why I hate most of the S&P 500 than there is upside. Right, the caveat is the NASDAQ stocks, right? Those NASDAQ 100 stocks. They're all on the S&P 500. They have almost all the cash and growth. Then there's a sprinkle of stocks in the S&P 500 that could be on NASDAQ if they wanted to be. but about half of the stocks that aren't QQQ stocks in the SP 500, they're just junk. They're big, but they're big junk, and you don't want them. So that's why I've been telling people for 5 years, buy QQQ, don't buy SPY. And that's been the bread and butter trade, right? I should have just poured into it a year and a half ago. I'll tell you what, if we get this 20 to 30% correction in QQQ, I will be loading up on it. And it's weird. QQQ probably only has 20 to 30% downside, but SPY probably has 30 to 50% downside. Well, what does that mean? That means that those non-QQQ stocks could all go down more than half, more than 50%. And there's a lot of them out there, a couple hundred of them. So I think SPY is just going to chop for years and years. I mean, it'll inch its way up, but it's not going to be like this rebound rally from the COVID crash. All right. I said a lot in a short amount of time. That's what I'm looking for. And I will get back to you soon. Ask your questions in the chat or at the bottom of articles. All right. Take care.